The decision to sell a profitable position is perhaps the most psychologically taxing a speculator must make. He is at war with two powerful and treacherous emotions: the greed that tells him to hold on for the last, fatal eighth of a point, and the fear that tells him to snatch a small profit before it can evaporate. Both are liars, and to listen to either is to court ruin. Jesse Livermore's approach to selling, like his approach to buying, was not based on these fickle emotions. It was a cold, clinical, and scientific process, a methodology built upon a single, unwavering allegiance to the facts as they were written on the ticker tape. He did not sell because he wanted to, or because he was afraid. He sold because the market itself told him it was time to sell. He understood that selling is the final act in a complete speculative campaign. The buying is the initial engagement, the holding is the long march, but the selling is the decisive battle that determines the campaign's ultimate success or failure. It is the art of converting a correct opinion, a paper profit, into a tangible, cash reality. This entire process was governed by a set of principles, forged over decades of both spectacular success and catastrophic failure. To understand how he sold when a trend broke is to understand the mind of a master who had learned, through painful experience, to subordinate his own will to the supreme authority of the market. First, one must dispense with the amateur's most common and foolish practice, the setting of arbitrary price targets. The trader who decides he will sell a stock simply because it has reached a certain price is substituting his own vanity for the market's wisdom. He is claiming to know more than the tape, a fatal form of arrogance. Livermore knew a simple truth: a stock is never too high to be bought, and by extension, a price is never, in itself, a reason to sell. The price is a number, the trend is a force. The speculator's business is with the force, not the number. To sell a stock that is in a powerful, healthy uptrend simply because the profit looks good enough is to commit a cardinal sin. He saw countless men sell a stock at 50, only to watch it, with deep regret, climb to 150. They had won a small battle but had missed the entire war. Their selling decision was based on a timid opinion, not on a change in the market's actual conditions. The only valid reason to sell a profitable position is the market's own clear signal that the underlying trend, the line of least resistance, has changed or is about to change. The speculator must wait for this signal with the same patience with which he waited for the initial buying signal at the pivotal point. His entire focus, once in a trade, was to monitor the stock's behavior. Was it still acting right? A stock that is acting right is one that is advancing with ease in a bull market, pulling back on low volume, and generally behaving as a leader should. The moment this behavior changed, the moment it began to act wrong, was the first warning signal that the end of the move might be near. This change in character was often subtle at first. A stock that had been a vigorous, powerful leader would suddenly become sluggish. It would churn, trading on very high volume but making no new upward progress. It would feel heavy, as if it were struggling against an invisible and powerful source of supply. This, Livermore knew, was the footprint of distribution. It was the sign that the insiders, the smart money who had accumulated the stock at lower prices, were now beginning to unload their large lines. They were feeding their stock to a public that had finally become excited about the stock's spectacular advance. This was the first, unmistakable warning to the observant speculator. A single day of such action was a caution. A second or third day was a confirmation. The tape was telling a clear story. The powerful, informed buying that had fueled the trend was now being replaced by powerful, informed selling. The character of the market for that stock was changing. After this initial period of distribution, the next piece of confirmatory evidence would often appear. The stock might attempt another rally, but this rally would be feeble. It would occur on noticeably lower volume than previous advances, signaling a lack of aggressive buying demand. The stock would fail to make a new high, or it would push through to a new high by a fraction and then fall back immediately. This was a clear sign of exhaustion. The buying power was no longer strong enough to absorb the institutional selling. This was the second, and more urgent, warning signal. Then would come the final, decisive break. The stock would violate a key support level, often the low point of its last minor pullback. When it broke this level, particularly on an increase in volume, the tape was delivering its final, unambiguous verdict: the upward trend is over. The line of least resistance has now shifted from upward to downward. This was the moment of truth. The speculator who held on past this point was no longer a speculator. He was a gambler, holding a position on the basis of pure, foolish hope. He was arguing with the tape, and the tape always has the final word. Livermore's own selling was as methodical as his buying. He did not dump his entire line in a single, panic-driven order. Upon the first confirmed danger signals, the churning on high volume, he would begin to test the market by selling a portion of his holdings. He would sell a block of 1,000 or 2,000 shares and watch the stock's reaction. If the stock absorbed his sale easily and rallied, he might wait. But if his sale caused the stock to become heavy and it did not rally, it confirmed his diagnosis. The stock was indeed weak. He would then sell more into any small, anemic rally that occurred. He did not sell on the weakness. He sold into the market's feeble attempts to regain its strength. He was distributing his line of stock just as the insiders had done before him, feeding it to the last of the hopeful buyers. This method required a complete detachment from the money involved. The amateur sees a large paper profit and is paralyzed by the fear of losing it. This fear often causes him to sell far too early, at the first sign of a normal, healthy correction. He is shaken out of the major move. Livermore had trained himself to see his positions not in terms of dollars, but in terms of points and behavior. His decision to sell was never based on the size of his profit or his emotional attachment to it. It was based solely on his cold reading of the ticker tape's action. He sold not because he was scared, but because his study told him to sell. He understood that no man can capture the absolute top. To try and sell at the very peak of a move is the same folly as trying to buy at the absolute bottom. It is a form of vanity. The goal of a professional speculator is to capture the great, solid, middle portion of a trend. To do this, one must have the courage to hold a stock through its minor, healthy reactions. But one must also have the discipline to sell it without hesitation when its character changes and the real danger signals appear. It is a delicate balance between patience and decisiveness. The cardinal sin, once the tape has issued its warning, is to begin to hope. Hope is the emotion that transforms a sound speculative position into a disastrous, long-term investment. The trader who refuses to sell a broken leader is a man who is substituting his own wishes for the market's facts. He will tell himself, it has gone down this far, it cannot go down any further. He will remember the stock's previous high price and believe it must surely return there. He is no longer reading the present action on the tape, he is living in the past, a fatal error for any speculator. Livermore never argued with the tape. He never held on to a position out of sentiment or loyalty. A stock was not a friend. It was a commodity to be bought and sold according to its behavior. When its behavior turned from bullish to bearish, his own position turned from long to neutral, or even to short. Just as group behavior was a critical confirmation for his buying, it was equally critical for his selling. When his leading stock began to show the signs of distribution, he would immediately turn his attention to the other leading stocks in that same industrial group. He would look for the same symptoms, churning on high volume, feeble rallies, and a general feeling of heaviness. If he saw that the entire group, the whole army, was beginning to show signs of fatigue and retreat, it was a powerful confirmation that the campaign was over for that sector. A single stock might top out due to a company-specific issue, but when the entire leadership of a group begins to falter, it is a sign of a fundamental shift in the tide. A single general cannot win the battle when his entire army is laying down its arms. To ignore this collective evidence is to be blind. The final and highest court of appeal was, as always, the general market itself. A great bull market does not last forever. Like all things, it has a beginning, a middle, and an end. The master speculator is a constant student of these great cycles. When Livermore began to see the signs of distribution not just in one group, but in multiple leading groups across the market, when he saw the market averages making new highs on roaring volume but with the old, true leaders lagging behind, when he felt a change in the atmosphere from genuine bullishness to a feverish public-led speculative mania, he knew the end was near. At such a time, he was not merely selling his profitable long positions, he was closing out his entire line of engagement on the bull side. He was converting his paper fortune back into the cold, hard reality of cash. He understood that in speculation, cash is a position. To be in cash, unburdened by any market opinion, is often the wisest and most profitable position of all. It allows the speculator to wait, with a clear and objective mind, for the next great opportunity to present itself. The amateur feels he must be invested at all times, that to be in cash is to be missing the action. The professional knows that there are times to be aggressively long, times to be aggressively short, and long, quiet periods where the correct position is no position at all. To know when to sell is to know how to complete a successful campaign. It is the final, disciplined act that separates the wishful gambler from the scientific speculator. It is the conversion of a correct judgment into real money. The speculator's job is to buy right and then sit tight, but he must also know when the sitting is over. He knows this not by listening to his own emotions, but by listening to the clear, cold, and impersonal verdict of the ticker tape. When the tape says the move is over, the speculator's job is simply to obey.